Okay, so let's get right into it. So what are some of the common commercial property types? Okay, so here are the three examples that everybody knows about, the office buildings, the industrial buildings, and the retail complexes. So these are probably your most common commercial property types. But there are other commercial property types as well, such as hotels, pubs, recreational, and there's more. And under the commercial property umbrella, there are also other specialized property types, such as car parks, education facilities, rural farming properties as well. And finally, there are institutional grade commercial property types as well. And these could include mines, could include infrastructure, could include transport and ports as well. So usually these type of assets are in the billions of dollars, which appeal to institutional investors. So all these property types fall under the commercial property umbrella. So what are some of the commonly used commercial property terms? So I'm going to go through about a dozen of these commonly used commercial property terms or jargon, so that you're up to speed with how commercial properties work. Okay, so the first one, the most obvious one, is SQM, which stands for square meter. Basically, everything in commercial properties is measured in square meters, unless you're in North America or in the US where you're still using square feet. But essentially, everything is measured in square meters, and it starts and stops there. The next term that's commonly used is yield, but more importantly, the difference between net and gross yield. Okay, so gross yield, well, what is yield? Yield is the percentage return based on the value of the asset. So for example, the asset is worth $2 million and you're receiving $100,000 in rent or in income, then that probably offers you a 5% yield. Okay, but the difference between gross and net is gross yield includes the outgoings, the property outgoings like land tax, council rates, roll rates, insurance, etc. Whereas net yield excludes the outgoings and just the rental. So I'll give you an example. Let's say we're looking at a property that's worth $2 million. The rent that's being paid at the moment is $100,000, and the outgoings payable on this property equates to $30,000 a year. Then the gross yield will be the rent, $100,000, plus the outgoings, which is $130,000, divided by the value of the property, which is $2 million, and that equates to 6.5% gross yield. Whereas net yield only takes into consideration the rent. So it's rent, which is $100,000 divided by the value of the property, $2 million, equals 5% net yield. So it's very important to know the difference between the gross and net yield, so that when you're doing your calculation, you're doing feasibility, you're putting the right figure. Now, as a side note, it's also important to understand the difference between a gross rent agreement and a net rent agreement. Now, a lot of investors are led to believe that the tenants, commercial tenants, pay all the outgoings on behalf of the landlord. Now, that is true in most cases, but in some cases, that is not true. Okay, so if the tenant has agreed to a net rent lease or net rental structure, then yes, what they do is they'll pay you, the landlord, the agreed rent, and they'll be responsible for the outgoings as well. However, if you've agreed to a gross rental structure, then all they're going to do is pay you the rent, and then you're responsible to pay the outgoing. So it's very important to understand the difference between the two. And when you are going through a lease document, make sure you identify whether it's a lease, gross or a net lease structure. Okay, so next term is the cap rate. So the cap rate is the capitalization rate, which is the rate of return or net yield that the property is expected to generate. Okay, so for example, Let's say we're looking at retail properties in Sydney CBD, and we identified that the average net yield for this type of property is 5%. So therefore, we can adopt that a cap rate of retail properties in Sydney CBD is 5%. So that's the expected rate of return. Another example will be, let's say the average net yield for commercial properties in Brisbane Metro is 6%. Therefore, we can adopt that the cap rate for industrial properties in Brisbane Metro is 6%. Okay, vacancy rate. So vacancy rate is basically, what are the percentage of properties that are vacant on a market at any given time. So it's the same as residential property. But with commercial property, it's very important to also understand the vacancy rate for each asset type and the sub-segments of the market. So what I mean by that is, let's say the vacancy rate across all office space in Sydney CBD is 9%, right? Then, then you can probably say that, yeah, the Sydney CBD vacancy rate is 9%. However, if you are looking at a specific sub-segment of the office space in Sydney CBD, you may find that the vacancy rate in B-grade offices that are under 500 square meters is 7%. Okay, or perhaps if you're looking at vacancy rates in A-grade office space between 1,000 and 3,000 square meters is 11%. Okay, and this can be applied to all different asset types as well, retail, industrial, et cetera, et cetera. So why is this important? Is because each sub-segment of the market has its own drivers and its own stories. Okay, so as a sophisticated investor, it is very important to know the ins and outs of each sub-segment as well. The next thing to understand is incentive. Okay, so what are incentives? So incentive is a tool used by building owners to entice businesses to lease their space within their property. Okay, so what are some of the common incentives? And some of these you'd have heard of. These include rent-free periods, fit-out contributions, lessor works, et cetera, just to name a few common ones. And incentive is usually expressed as a percentage. So what I mean by that, so let's say you've agreed to a 6-month rent-free period on a 60-month term, then that means the incentive that's been agreed equals to 10%. Okay, another example is, let's say you've agreed to a 3 months rent-free period on a lease term of 2.5 years, which equates to 30 months, then the incentive agreed is equivalent to 10%. Okay, now that you understand incentive as a percentage, it's also worth noting the difference between effective rent and face rent. So what's the difference? So face rent is what is written down as the rental payable irrespective of the incentive, and effective rent is the actual rent that the tenant is paying, which factors in the incentive that they're receiving. So as an example, let's say the rent agreed is $100,000 per annum, and you've agreed to a 5-year lease term and the incentive 10%, then the face rent is $100,000. Okay, but the effective rent will be $100,000 minus 10% because you're giving away 10% incentive. So the effective rent is $90,000. Okay, so again, when you're going through tenancy schedules, when you're analyzing properties to buy, it's very important to distinguish between face and effective rent. Zoning. So zoning is basically, what zoning means is, lands are subdivided into zones in order to control how much land is used, including how much space can be built on it, and what type of buildings can be built on it, and what type of businesses are allowed there. Okay, so some of the most common zonings, they include like mixed-use zonings, industrial zonings, residential zonings, town centers, etc. Okay, so basically zoning means what is allowed to be built on the land and what type of business is allowed to operate from this property. So, for example, you can't build a residential property inside an industrial zoning. Okay, so if you bought an industrial piece of land, you won't be permitted to build a residential property on top. Or, another example is you can't have heavy manufacturing businesses inside a residential zone. Okay, so zoning governs what can and can't be done on the property. Options. Okay, options is something that is used very regularly in the commercial properties arena. Okay, so there's a few different types of options. So the first one is a lease option. Okay, so lease option gives the option holder, and 99% of the time is the tenant, the right to extend the lease beyond the current term. Okay, so as an example, you might have seen these in the past. There are tenants that sign a 3+3+3 year lease or a 10+5 year lease. What that basically means is they've agreed to an initial term of 3 years, but they also have the option or the right to extend their lease for another 3 years and another 3 years after that. Or in this example, they've agreed to an initial term of 10 years and an option to renew the lease for a further 5 years. Now, it's very important to understand that 3+3+3 years doesn't mean a 9-year lease. Okay, so a lot of investors make the assumption that because a tenant has an option, that they're going to stay. That's completely false. The lease option gives the option holder, which is a tenant, the right to extend their lease. It doesn't give the landlord the right to enforce the tenant to renew the lease. Okay, so it's a little bit misleading if an agent tells you that a 3+3+3 lease is a 9-year lease, because it's not. Okay, the second type of option is a purchase option. So there are two types of purchase options. There's a put option and a call option. A put option gives the vendor, the seller, the right to force the buyer to purchase the property at a price that was previously agreed. Okay, and a call option gives the purchaser the right to force the vendor to sell the property to the purchaser at a price that was previously determined. Okay, so the put and call options are similar to shares. And then finally, you have lease plus purchase option. Okay, so basically what this is an additional clause in the lease giving the tenant a call option. So practically how that works is, let's say the tenant signed a 5-year lease and they have a purchase option which they can exercise at any time during a 5-year term. And that means that at any time during the 5 years, they can exercise the option and buy the property from the vendor or from the owner. Okay, excuse me. Okay, next one is rental review. Okay, so rental review simply means at the anniversary of the lease, how is the rent going to be adjusted? Okay, so it could be every anniversary, it could be monthly, it could be biannually, whatever you've agreed with the tenant. But the most common rental review is annually. Okay, and there's a few different types of rental reviews. Okay, so you've got the fixed reviews, which are usually expressed as a percentage. So it could be a 3% annual increase, 4% or 5% annual increase. There's also CPI reviews. So the rent gets increased in according to what the CPI is on the previous year. So at the anniversary of each year of the lease, the rent goes up by the percentage indicated by the CPI. And there are also market reviews. Okay, so market reviews basically looks at what the current market rent is for that particular asset type. Okay, so why is this important? Because sometimes market rents grow at a faster pace than your fixed reviews. Okay, so if you sign up a tenant on a long-term lease, sometimes it is advantageous to have a market review so that the market rent doesn't run away from what the tenant is paying too much. Okay, so there are a few types of market review. So there's an open market review, which means whether the market goes up or goes down, the new rent is adjusted in accordance to whatever the market rent is at the time. There could also be a ratchet market review, which means that the new rent can only go up. It cannot go down. It cannot go below what the tenant was previously already paying. Okay, it's like a ratchet. If you guys know what a ratchet is, it only goes. It's a tool that only goes one direction. And then there's also a cap and collar, which means that the market review cannot exceed a certain amount, which is a cap, and it also cannot go below a certain amount, such as a collar. Okay, so for example, it could be an open market review with a cap of 10% and a collar of 10%. So which means the rent cannot go above 10% of the previous year, it cannot go below 10% of the previous year. Okay, so give an example. Let's say you've agreed to a 4% annual fixed review with a market review year 6. Okay, so let's say the starting rent is 100,000. So in year 2, you add 4%. In year 3, you add 4% of the previous year. Year 4, you add 4% of the previous year, and so forth. And then in year 10, you have a market review. So let's say the market's gone up 10% at the time. Then you can see that the rent's been adjusted in accordance to what the market rent is in year 6. As you can see, there's a 10% increase here. Okay, DA, development application. So development application is a formal application submitted to your local consent authority, or AKA council, for permission to carry out a new development. Okay, so what is a new development? So new development doesn't necessarily mean building a new building. It could also be just changing things inside the building. It could also refer to what is the approved usage. So for example, if you're looking at leasing a property, it was previously a newsagent, and now you want to put in a dental practice in there, then that will be considered a new development. Okay, so it's approved usage, conforming usage, which means let's say there was a dental practice in place, but they moved out recently. But because it already has a conforming use, then you can just move in straight away if you want to use it as a dental practice. You've also got approved developments, which is literally doing some sort of building works, renovations, extensions, or building something from scratch, or perhaps an approved change of use. So as an example that I've just used, you want to change something from the was before, let's say news agency, to a dental practice, which is a change of use. Because all that will require a DA. And finally, WALE. Okay, what is WALE? WALE stands for the weighted average lease expiry. The weighted average lease expiry is used to indicate the average expiry period of all the leases within a property. The WALE is commonly used to assess the income risk profile of an asset. Okay, so for example, I demonstrate what I mean by this. So let's say you own a property with 3 tenants in place. You've got tenancy A, B, and C. Tenancy A, their lease expires in 12 months. Tenancy B, lease expires in 20 months. And tenancy C, lease expires in 35 months. So the WALE will be the average of the 3. 12 plus 20 plus 35 divided by 3 equals 22.33 months, or 1.86 years. So just by looking at this, I can see that the risk profile or the income risk profile of the asset is 1.83 years, as in after 1.83 years, I might stop receiving income. Okay, obviously this is continually evolving as you renew leases and get new tenants. But if you're analyzing a property as a snapshot, a WALE is a really good indication of what your risk profile is. Banks and valuers very often refer to WALE to assess the risk profile of the asset when they're determining lending and things like that. Now, you can also calculate WALE by lettable area. And you can also calculate WALE by income as well. So which would then give you an indication of how many square meters inside my building is up for expiry, and also in terms of income as well. Okay, so we've just covered off the commercial property one-on-one terms, frequently used terms. The next thing I want to now look into is how to actually determine fair property value. Okay, so this is not the official valuation method, but this is a couple of methods that property investors can use very, very quickly to determine fair value of a commercial property. Okay, excuse me. Okay, so the first one is the cap rate method. Okay, so we explained what cap rate meant. So as an example, if you're trying to determine value of property, first of all, you look at what is the rental income of the property. So let's say the rental income of the property is $100,000 net, and we've determined that the cap rate of the property is 5%. Then if it's a tenanted investment, then the value of the property will be $100,000 divided by 5%, which equates to $2 million. So this particular scenario, this property's value is probably around $2 million. Okay, so what if the property is vacant? How do you then work out what a fair value of the property is? Because you need to account for vacancy rates, incentives, and this and that. So a good way to look at it is figure out or estimate, what is the expected vacancy period. So let's say this property will likely be vacant for 6 months before you can secure a tenant. And the expected incentive, to secure a tenant is 6 months. Okay, so your vacancy rate is 6 months and your expected incentive is 6 months. That's 12 months worth of rent. So to determine the a fair value of the property, you would do the cap rate calculation, assuming the property is fully let at $100,000 per annum, divided by the cap rate, which equates to $2 million, minus what is your expected cost to rent the property out, so which is $100,000. So the property value, the fair value of the property, is more likely to be $1.9 million, because you're taking out the potential vacancy and incentive. Okay, the second method of determining value is the comparative sale method. This is basically just comparing what is the average price per square meter achieved in the market, and you then compare that to your property. Okay, so let's say the property size is 1,000 square meters, and we've determined that the average price per square meter of comparable sales is somewhere between $1,800 to $2,000 per square meter. So then the value of the property is simply 1,000 square meters times 1,800 to 2,000, which equates to somewhere between $1.8 million to $2 million. Okay, so pretty straightforward. Now, please note that in a perfect world, the cap rate and the comparative sale method should actually match up. So in a perfect world, you should conclude at the same dollar amount. But sometimes it doesn't. Okay, sometimes it doesn't match up. So therefore, you may need to factor other considerations as well. So I'll give you a quick example here. This is something that occurs quite often. So let's say the property is under rented, okay, because the current landlord is a nice guy and has never increased the rent. But we know that the market rent is $100,000, but the tenant is only paying $70,000 at the moment. So in order for us to calculate the cap rate, calculate the value using the cap rate method, then it equates to $70,000 divided by 5% cap rate, which equates to $1.4 million. Obviously, there's a huge gap between $1.4 to $1.8 million. Okay, so what's actually the fair value of the property? Like, what should you, as the investor, actually pay for it. So you have to now start factoring other considerations. Okay, so for example, as an investor, that this property might actually be worth more if it's vacant, because the current tenant in place is actually pulling down the value because they're not paying a lot of rent. However, you've noticed that their lease actually expires in 12 months' time. So which means in 12 months' time, you can do a market review, or you can replace the tenant and bring the rent back up to what the market rent is of $100,000. So you might say to yourself, what are my opportunity costs? Well, maybe I'll pay $1.6 million for the property, because I know the tenant's going to move out in 12 months, and the property will probably worth somewhere between $1.8 to $2 million. So I'm still making a bit of money. Okay, so this is just an example. Obviously, there are other factors to consider, but in a perfect world, the comparative sales method and the cap rate method should match up. Okay, so moving on. So one of my favorite parts, which is lease structure 101. Okay, so the lease for a commercial property is very important, because the lease will make or break the commercial property. You have a good lease in place with a good tenant, with good rental structures, good rent reviews, your property is going to be worth more. If you have a poor tenant in place, you have bad rent, you have bad rental review structures, your property is going to be worth less. So it's very important to pay attention to some of the key clauses in the lease when you're structuring the lease, or when you're negotiating the lease with a prospective tenant. Okay, so the first one obviously is the rent reviews. Okay, so let me show you two scenarios and demonstrate why rent reviews are so important. So let's say in scenario one, you've negotiated a new lease with a tenant. The starting rent is going to be $100,000 per year. You've agreed to a 5-year lease term with a rent review, a fixed review of 2.5%. Okay, so year one's 100,000, year two is 102,500, et cetera, et cetera. So over the 5-year lease term, you will have collected a total of $525,633. And the passing rent in year 5 will be $110,381. Okay, pretty straightforward. Now, how does that affect the value of your property? So let's say the cap rate of the property is 5%. At the end of 5 years, your property is going to be worth somewhere around $2.2 million, because it's 5%. So it's because it's a passing rate, 110,000 divided by 5%. So your property should be valued at around $2,207,000. Okay, so that's scenario one. Scenario two, everything is the same except the rent review is now 4%. Okay, so it's only 1.5%, difference, right? But it could have a really profound effect. Okay, and let me show you exactly what I mean. So just by increasing the rent review by 1.5% per annum, you'll be receiving a total of $541,632 over the lease term. The passing rent at year 5 will be $116,986. And if you apply the same cap rate on the property will be valued at $2,339,720. So in scenario 2, over the 5-year term, you would receive an extra $16,000 in rent and an extra $132,000 in property value. You see the profound effect it has just by adjusting the rent review by a small magnitude of 1.5%. You've affected over 6% of your profits. Okay, or not profits, sorry, of your property value, which is huge. So don't be afraid to negotiate a little bit harder on the rental reviews. Okay. The next thing that is very important to understand is the rental incentive structure. Okay, again, I'm going to show you two scenarios and where a lot of property investors make a mistake. Okay, so let's say you're a landlord, your property is vacant, and you've put the property on the market, and the asking rent is $100,000 per annum. Tenant comes along, really likes the property, starts negotiating, and you've agreed to give the tenant a 20% discount on the rent. So the agreed rent now becomes $80,000. Okay, they've agreed to 5-year lease term and a 4% fixed annual rent review. So your income becomes $80,000 in year one, $83,200 in year two, and all the way to year three. So the total rent received will be $433,306. However, the passing rent in year five will be $93,589. So if you apply a 5% cap rate on the property, your property will be only worth $1,871,000. Okay, because you've given the tenant a 20% discount on the rent. If we look at scenario two, same parameters, except the only difference is instead of giving them a 20% discount on a rent, we're giving a tenant a 20% incentive in the form of a 12-month rent-free period. So if we look at this across the board, then in year one, because you're offering a 12-month rent-free period, because you're receiving zero rent, or you can structure the rent incentive differently. Maybe you can spread the rent-free period across 2 years or 3 years. So maybe in year one, year two, you're receiving half rent. Like, it doesn't matter how you structure it. But the point of the story is the passing rent in year five is $116,962. And the property value, using the same cap rate, same property, same everything, is worth $2,339,000. So there's over $500,000 difference in property value. So a lot of property investors shoot themselves in the foot, because rather than offering them an incentive, they're offering them a discount in rent. Okay, so it's very important that you know how to structure the incentives properly, particularly when you're valuing the property. The valuer is always going to look at the passing rent. Okay, in some cases, obviously, they'll factor in the rental incentives if there's any outstanding rental incentives. But assuming there's no outstanding rental incentive, the valuer would just look at what the passing rent is. And if you're offering them a straight up for 20% discount, it's going to have a profound effect on your property value. So as I mentioned a little bit earlier in the masterclass, rental incentives have a direct impact on your property value. So really smart investors know how to use incentives well to increase their property value. Oh, as a side note, if you're looking at buying a property, watch out for any unpaid incentives that's owing to the tenant. Okay, so for example, the vendor might have agreed to a 6-month rent-free period to the tenant, and you're looking at purchasing the property just 2 months into the new lease. That means there are 4 months of rent-free remaining that's owing to the tenant. Okay, so if you're not careful and you've just bought the property without knowing this, then you're going to be liable for the 4 month of unpaid incentives owing to the tenant. Now, in most cases, particularly with what I do, we do our due diligence very, very carefully. So we'll be able to pick up on some of these things. So what we usually do is we organize a rebate at settlement of whatever the unpaid incentive is owing to the tenant, and that amount is rebated back to the purchaser. Option terms is another thing that occurs very often in leases. And as I mentioned before, options gives the tenant the right to extend their lease term. The landlord has no control over whether the tenant exercises the option or not. So therefore, there is actually no advantage for the landlord to grant any options. So let's say if you were planning on redeveloping the property, but you've locked into a 3+3+3 year lease term, then you're at the mercy of the tenant. Okay, so it has no advantages to the landlord by offering an option term. However, practically speaking, we do understand that as part of negotiations, you may have to look at offering an option term to a prospective tenant. Okay, so sometimes you may offer an option. However, you want to make sure that you structure an appropriate market review and option. And also, as a reminder, when you're looking at properties that already has a tenant with option terms, a 3+3+3 year lease term does not mean a 9-year lease. Okay. Security, obviously, when you're leasing out the property, you want some sort of bond, some sort of security in case the tenant moves out, goes bust, or he's not fulfilling his obligation in the lease. That you want some sort of leasing security. Beg your pardon. So here are some of the common lease securities. So bank guarantee is basically a certificate issued by a bank that guarantees a certain amount. So bank guarantee is actually pretty good for a number of reasons. One is pretty much as good as gold, but assuming the issuing bank is a reputable bank and not some dodgy bank. So you can usually claim the bank guarantee without a lot of hassle. And the advantage for the tenant is that rather than handing over cash to the landlord in the event of disappearing with it, they can actually put the money in the bank because the bank would need some sort of security. And usually they'll put it into a long-term deposit and earn some interest on the money. The other one is cash bond. Obviously, that's pretty straightforward. It's just, whatever the bond is paid in cash to the owner. And there's also personal guarantees as well. So I see a lot of investors insisting on having a personal guarantee. In some cases, that's good. But in my opinion, in most cases, it's pretty useless, particularly if you're looking at a low rental amount. So you're looking at leases that are worth maybe $30,000, $40,000 a year. It's probably going to cost you that amount in legal fees just to recover any personal guarantee. And if the lease amount is huge, $300,000, $400,000 a year, again, there's no point in trying to recover personal guarantee because the director or the person who's guaranteeing it might not have that sort of amount of wealth or asset equivalent to that. And just the process of, getting the personal guarantee is also really lengthy and drawn out and complicated. So in my opinion, personal guarantees are not really, practical. But hey, it's better to have it than not. Okay. The industry standard for security is usually between 3 to 6 months of the gross rent. And ideally, the amount of security that you have is enough to cover the cost of make good if the tenant goes bust and or reletting. Okay. So if the tenant goes away, you want enough money to fix up the place and to find a new tenant. Sublease or assignment. So what is that and why is it common in a lease? So a sublease allows the tenant to sublease part or all of his premises to a subtenant with the landlord's reasonable approval. It's worth noting that under a sublease arrangement, the first tenant is still fully responsible for all the obligations under the lease. So, for example, let's say with residential property, let's say, you have flatmates. What typically happens is you have one person that signs the lease with the landlord, and then you will then sublease your spare bedrooms to your flatmate, and you collect their rent, and then you just pay the landlord rent. So, same sort of thing here. But why would it occur in a commercial property? Well, there's a number of reasons. So, for example, let's say the tenant has restructured their business. They don't need all that office space or that industrial space anymore. They can then, sublease part of it to another company and, receive some sort of income from that. Or another really good example are, co-working businesses, co-working space, like WeWork or SurfCobb. Their entire business model is built upon renting a large office premises, putting in the infrastructure and offices and desk, meeting room, and then subleasing it into smaller tenancies and receiving a premium on top of it. And so what's the difference between assignment and sublease? An assignment allows the tenant to assign the lease and all of its obligations to a new tenant, or otherwise known as the assignee. So what are the pros and cons of an assignment? Well, let's say the first tenant is a tenant of good quality. Ideally, as a landlord, you want to replace them with a tenant of equal or better quality. But sometimes that's not the case. Now, usually in all these commercial leases, assignments are subject to the landlord's approval. Okay. And why would a company look at assigning the lease? Well, there's a number of reasons. One example will be because the business has been sold. Business has been sold and they don't need the space anymore, and they want to sublease it so that they get rid of their obligations. Or another reason is the business have outgrown the space, so they move to a different premises and they don't want to let go of the obligations on this particular lease. Okay, so the number of reasons why a tenant will want to assign the lease. Okay, all right, so I've covered a lot so far. And the next thing I want to move into is to provide a simple cash flow projection framework that you can use when you're analyzing cash flows of commercial properties. Okay, so this framework can be applied to different types of asset classes: commercial, retail, industrial, et cetera, et cetera. So there's a number of things to factor in. So number one, as you can see on the first line, is what is the potential income of the property? So that's basically from your regular rental of floor space. So whatever the potential income is, you factor that in. And what are some other potential incomes that you can derive from the property, such as signage rights, maybe short-term storage, car parking, etc. So that would then give you a total potential gross income. The next thing you want to factor in, which is very, very important, what are the potential vacancies and incentives payable, during the first, let's say, 3 to 6 years of the property. Now, what I personally like to do is I like to put down what is the average vacancy rate for that particular type of property across the board. Okay, so let's say this is an industrial property, excuse me, and the average vacancy for this type of industrial property is 5%. So I would typically put 5% across the board, because that allows me to work out or account for any potential vacancy. And then the next thing I would do is have a look at whether the property is vacant or not. So in this example, let's assume the property is vacant. So I need to factor in, what are my letting costs and what are my incentives that are payable. Okay, so maybe I structure a deal where the incentive is paid across 4 years. So it's paid 5% and then 3% and then 2%, 1% across 4 years. Then I would factor that into my cash flow projection. That would then give me my effective rent. And then the next thing I need to take out are what are my operating expenses. So assuming this is a gross rental structure, I'm paying the outgoings, then I need to factor in, what are the expenses. And I also need to factor in what might be a reasonable increases in outgoings. So, maybe it's reasonable to assume that your operating expenses are going to go up by 4% per annum, or 5%, or 2%. Then you also factor that in across the board as well. That will then give you your net operating income less your debt, whatever you're paying mortgage, which would then give you your net cash flow before tax. Okay, so important to work out some of these variables and factor them in as well, which will give you a pretty good cash flow projection going forward. And with this in mind, you may be able to work out a number of things like, what it would be an ideal time to sell the property, when would be an ideal time to leverage the income of this property to buy another property, et cetera, et cetera. Moving on, I'm going to also provide a simple feasibility framework. So if you're looking at some value add opportunities, it's really important to figure out whether it's profitable or not. So I'm going to look at a simple feasibility framework. Okay, so let's say you're looking at a refurbishment project, okay, on a vacant property. So first up, you look at your acquisition costs. So how much is the property to buy? Obviously, stamp duty associated with it, and any closing costs such as legal costs, adjustments, and things like that. So that would then give you your total acquisition costs. So in this example, it equates to a little bit over $1 million. Then the next part is how much is the project going to cost you to execute. So if I'm looking at a vacant property and I need to spend money refurbishing it, I need to take into consideration a number of things. One is the vacancy period. So I'll probably still be paying interest and outgoings on it. How much it's going to cost for me to lease the property out, as in paying agent leasing fees. What are some of the incentives that I might be out of pocket for, and how much is it going to cost to refurbish the property, and also factoring some contingencies as well. So after factoring all this in, it will then give me the total execution cost, which would then give me a total project cost of this amount. So in this example is $1,656,000. Now, assuming after refurbishment and repositioning the property could be sold for a little bit over $2 million. I would then factor in how much it's going to cost me to sell the property. So it's going to obviously cost me some legal fees and some commissions. So my net proceeds after selling the property is going to be $210,000, which would then give me a net profit in this example of $354,000, which equates to a project margin of 21%. And if I'm borrowing 70% from the bank, it will give me a 38% return on investment of equity. Okay, so like I said, this is just an example, but it gives you a really simple framework to very quickly work out whether a project is viable or not. Okay, so before we move on to the case studies, just one last thing I want to cover off, which is what are some of the common funding options available in the market at the moment. Okay, so the first one, which is the most common one and most obvious one, is a full doc application. So full doc application, similar to a residential full doc, is basically the lender would look at all your financial statements, your tax returns, your bank statements, et cetera, et cetera. The advantage of a full doc is you can potentially borrow up to 85% LVR. Usually it's 70%, but in some lenders can go up to 85%. And the interest rates as of today, it starts from about 5.61%. And the lender will use the property as its primary security over the loan. The next one is a low doc. So again, similar to a residential low doc, the lender will require less documents to assess your borrowing capacity. So this could be your BAS statement or your accountant a letter from your accountant to verify your income. Some lenders will lend up to 80% on a low doc, and rates typically start from 6.1%, so a little bit higher. And again, the lender will use the property that you're purchasing as security for the loan. The next one is a lease doc loan, something that's becoming very, very popular recently. This one, the lender will assess the property in isolation without considering your income statements or your financial capacity. And the way they do that is they assess the existing income in the property. So for example, if the property already has a number of tenants in place, the lender will look at the combined income and use that to calculate the borrowing capacity. Typically, the lenders will use up to 70% of the passing income on the property to work out its borrowing capacity on the asset. You can potentially get up to a 70% loan or 70% LVR, and rates typically start from 6.21%, and I've seen some rates go up to nearly 7%. They'll use your property as security for the loan, and there is typically a requirement that the minimum WALE of the property that you want to buy is 1 year. So you have a minimum 1 year WALE of the property. Most or some sort of lease doc lenders would only provide a loan term up to what the WALE period is. So for example, if your WALE of the property you're looking to buy is 3 years, then some lenders would only give you a loan for up to 3 years. Okay, so something to consider. So one thing to add, so a lease doc loan is very useful for someone who's already maxed out their personal borrowing capacity. Someone who's got a lot of equity, a lot of cash for a deposit. You can use a lease doc loan to buy commercial properties because it allows you to buy multiple properties without really affecting your borrowing capacity. So that's why this lease doc loan has become very, very popular recently. Private funding. So private funding, usually for people that have exhausted all other funding options. They can't get more funding from banks, lenders, so usually they go to a private lender. Now, private funding, in terms of assessment, depending on the private lender, they'll either apply a full doc, low doc, or no doc assessment. Typically, you can get loans up to 75%, but the interest rates are usually quite high. The typical range is between 9 to 15%, but in some cases, I've seen private lending interest rates go up to 20%. In terms of security, typically they'll ask for a first or a second mortgage across the asset. And then finally, one of my favorite is vendor finance. So vendor finance, everything's negotiable. Basically, what you're doing is you're asking the vendor to fund your or part of the acquisition, or in other words, you're delaying payment to the vendor, and in exchange for whatever you agree. So for example, let's say you're buying a $10 million property, and you're asking for $2 million vendor finance, which means you're going to pay the vendor $8 million now, and then $2 million later at a date that's predetermined. Let's say a 2-year vendor finance, and in exchange, you're going to pay the vendor, let's say, a 10% annualized interest. The vendor would obviously want some sort of security, and that's negotiable. Typically, they'll have security over the asset that you're buying, or another asset that you might own.